Hello, everyone. This is Nikos speaking, and the purpose of this video today is to show you some analysis I've done on the cash management. The cash management means how do we decide when to get in or get out of our position in the miners and Bitcoin, and by what amount. So I've looked into three things that I'd like to show you. The first thing is I've looked into one technical indicator, the RSI, Relative Strength Index. So if you go to Yahoo Finance and you look at Bitcoin in the interactive chart, you can load an indicator by clicking here, indicators. In this case, I've loaded RSI. And RSI is the relative, it means relative strength index. And typically, when this index is below 20, the stock is considered as oversold, and when it is above 80, it is considered overbought. So you can see here, for example, in this period between the 1st of January and the 9th of January, it is marked as green, so it was considered as overbought. And indeed, it was the moment where we had this massive spike in Bitcoin. So it is possible that we could associate our getting out of our position in Bitcoin and the miners when we have this kind of overbuying situation. So RSI is an interesting index because it is also relative. So it always goes between 0 to 100, regardless of where is the underlying. And for that reason, you can compare different moments in time, regardless where of the actual value of the underlying. One disadvantage is that it does not take into account the high, the low of the day, or the volume. So that information is leaked out, so it only takes into account the close. But nevertheless, it is quite easy to understand here and to track it. And it is also easy to reconstruct it. So that's the first thing. The second thing I looked at was by looking at Google Trends. So if you go to Google Trends and say Bitcoin, so Google Trends will give you a graph. It will give you a graph also between 0 and 100, and you can customize your graph here if you want to look at it worldwide or the past 12 months or any other time period. And you can also nicely download with this button here the data. So that's also interesting because the data is available to us to make some analysis. So I'm not 100% sure what is behind the scenes when we construct the Google Trends. It's probably related to the amount of searches, but exactly how, I don't know. But we can also see that here, when we had the spike, the period where Bitcoin spiked around early in January, Google Trends also showed a big spike for Bitcoin, so it is possible that these two are correlated. So that's the second thing I looked at, and then I'll come to the third one, which is a little bit more complex in a minute. First, I'd like to show you how I've looked into RSI and Google Trends. I'll start with RSI. So the first thing I did is I got all the data for Bitcoin dollar from Yahoo Finance. I downloaded it. I sorted it by day. Well, it was already sorted. And then in this table, what I'm doing is I'm constructing myself RSI so that I don't have to always rely on downloading the data from Google. That's because this number here, I cannot get it out. I cannot download RSI. I can download the Yahoo Finance, the close data for Bitcoin, but not RSI. So that's why I made it myself. So I looked it up how you make it, and these numbers that I get pretty much agree with Google. So I'll show you how it is done. So on every day, say for this day, I compute here the first thing I make after date is a column called change, and change records the difference between the previous close and today's close. So after you compute change for all dates and you propagate the formula, then you go into gain, and gain simply says if the change was positive, just put that number. If it was negative, like here, just put a 0. So there is an if statement here to check if it is positive or negative. So here we put all the upside changes, and similarly here we put all the downside changes, but with a flipped sign. So after we construct these two columns of gain and loss, then we compute the average gain. And the average gain is, if I go here, so this looks at the average between all these gains. These are exactly 14 gains, 14 numbers, and the reason why it is 14 is because also Yahoo Finance here, it says 14. Why 14? You can also customize it and make something else, but it appears that this is right now best practice, perhaps. So then similarly, you can compute the average loss by averaging across the past 14 losses. So, and then after you have the average gain and average loss, you compute the relative strength, which is just the ratio between the two for any row, so any row. And after you compute the relative strength, now you can compute the relative strength index, which is just a rescaling of this number in the 0 to 100 range by using this formula here, which I looked up in Wikipedia. So then I have my relative strength index, this, which is marked with this boldface. If you look up the value, let's say around the peak of Bitcoin, so the peak was around here, 9th and 10th of January, with Bitcoin around 40,000. I have a value of 91 and 82 of the relative strength index, and that is pretty much in line with what Yahoo Finance gives me. Maybe not exact, because maybe there is some smoothing going on here. When I say smoothing, maybe they apply also a moving average across the relative strength index. I don't know, but it's pretty much in line. So now I can use it on a daily basis simply by getting my data from Yahoo Finance or Google Finance. So the second thing I've done is the Google Trends. Now, I didn't do any computations here. I simply downloaded the file from Google Trends, and here are the numbers. The numbers I showed you are just here. So then I put the Google Trends number. I aligned them for these exact dates, also here and here. And the third thing I've done, now I can explain, it was I've computed something that looked a bit like the VIX Index. What's the VIX Index? It's a useful indicator that is quoting generally the amount of volatility expected by the market in the future. So it is constructed from volatility options. So not historical data, but options. So it's looking forward. It's looking ahead. So the volatility index is here. This is it here. That's for the entire market. In fact, if I zoom out as much as possible, I see here that in the crisis of 2008, in the bank crisis, it spiked around 80, but normally it is around the 20s and 30s. So a low number of VIX means that the market is anticipating in the future small volatility, but a big spike like this one, it means that the market is anticipating a large amount of volatility coming up. So I thought it might be interesting to have something similar for Bitcoin, because this gives you an idea of what is the market thinking. This index is relative. So if you look at any moment in time, the VIX index from the 90s up to 2000, these numbers are comparable because they have to do with the standard deviation, not the actual value of the underlying. So that's also why it's interesting. So here is my poor man's solution of how to make the VIX. It's not at all the same, but it's something similar. So for each day, I computed the relative change in value, and that gives me the daily returns. So that means that this 0.8% means that the change from this day to that day was 0.8%. That's what it means. And after I get all the daily returns, then I compute here the standard deviation of these past 4 daily returns. And I roll this standard deviation over and over and over again. So this number here is the moving standard deviation of the historical data. So it's how much volatility did we have in the past, and how is that trending towards time. And that's for 4 days, and that's for 10 days. So how does it look like? So it looks a bit like this, the moving standard deviation. I can see that in the most recent times, which is here, this has been trending upwards for Bitcoin. So the market has been experiencing more volatility. And of course, this doesn't say 100% what the market is anticipating, only what is experiencing right now. But anyway, maybe this is also a good proxy. So my intention was to make something like the VIX index for Bitcoin, but for that you need data from options, and which was not available to me. So this is the next best thing. So then after I have all this data, I've put all this data here next to my closing prices from Yahoo. This is the data I had for Bitcoin, Mara, Riot, Bitfarms, Hut8, Argo, and Hive for those dates where we are tracking BMXI. And here are the BMXI values for those dates. And here I am looking up VLOOKUP of all the values I constructed for RSI, for Google Trends, and the moving standard deviation for those exact dates. So now I have 2 tables, one giving me the values of the underlying, and the other giving me the values of the 3 indicators I made. So the idea is here that if I see that the RSI is going up, I start getting out of my position, and if it goes down, then I start getting in. So that's what I wanted to test, and here I started making that test now. So I made a small weighting scheme, so you can question it and challenge it, but of course I'm not 100% sure this is the scheme to do, but okay, it's a starting point. So what I said here is that let's assume RSI goes from 10 up to 100, and if it is 10, then my cash position is 0. So all my money goes into the miners or Bitcoin, and gradually I increase it up until I go to 100%, where I say my cash position then is 25%. So I have moved a lot of capital into my cash position. So these numbers here is this ladder here. So I tried to make it a bit intuitive because if you run the Excel solver like I did in the previous video to give you the optimal weighting scheme, so it gives you some spikes at certain moments. Of course, that's because the solver is overfitting totally the data for these 19 data points. So, but those spikes are not explainable like in business terms, while this kind of ladder scheme is more intuitive and understandable. So I've made this just as a starting point to see where do I end up. And similarly, I made a weighting scheme here as a starting point for my Google Trends indicator. And also for the moving standard deviation, I made also some kind of ladder here, and I try to see where do I end up. If I then I go to this table, which is a portfolio where I have the top three BMXI stocks at any given moment in time, plus a cash position. For every date, I track down what is my Google Trends, and every day I start with a P&L. So not every day, but my starting point is a P&L of 10,000. And then the first change of the P&L is going to look at the 4 weights that were observed 2 days before for the 3 stocks and the cash position. So let's look at it one by one. So this the weight 1 is going to so let's first start with the weight of the cash. So this weight of the cash is going to VLOOKUP that value here across the weighting scheme. So it's going to give me the weighting according to my weighting scheme, in this case 2267. So it gives me 0.05% cash position. And then each of these weights of the 3 stocks is going to say out of the remaining 95% of my position, then assign a weight which is proportional to the value of the BMXI, here it is, of the BMXI of the first stock normalized by the sum of the 3 values of the top 3 BMXI stocks. So these 3 are all proportional. So the same happens for weight 2 and weight 3. So if I sum them up, you see that they are all 100% all the time. So 100%. So that's good. And then my P&L here is going to look into compounding the previous values, the previous day's P&L, weighted by the weights I had observed 2 days before. That's because I want my BMXI to have some predictive power. So I use it in the past in order to be able to do something with it in the future. So 2 days, the lag is because the logic is I observe the weights on this day. On the next day, I make the swap if needed to a new position. And then on the 3rd day, I observe in the market the returns, the daily returns, and I adjust my P&L. So these 3 returns are looking into the returns I constructed here. So it's I have constructed them here for each day, and if I want to show you these daily returns, they are looking into the relative difference of each underlying from one day to the next. So I'm compounding then my P&L day by day by day. So then for, sorry, this is another portfolio, so I go here. So then if I keep on compounding like this day by day by day by day, and I continue up until the last day of my data I have for my Google Trends with this weighting scheme that appears here, I arrive at something like 74,000. If I do the same but using the RSI weighting scheme, I have something like 73,000, and with the moving standard deviation, I have something like 77. So I must have changed something because here I have another number, but what happens here, then I collect all the results together. And I see that, so these are all the collected results together, but with one small addition. The addition is that because I'm not sure exactly of where is the right weighting, what is the right weighting scheme with the right ladder? Is it this one, or is it more steep, or is it more convex? I'm not sure. So I've done a very small sensitivity analysis around my weighting scheme where I say that suppose I move the entire ladder downwards by 0.1 or downwards by 0.5, so in parallel. Of course, it has to be floored and capped between 0 and 100. That's why you see here the min and the max, because there is a flooring. So I said, suppose I move in parallel the ladder up and down around this weighting scheme, what would happen to my portfolio? And these are the new values I obtain. So what I see here from this table is that if I simply consider the weighting scheme as it stands right now for RSI, Google Trends, and a moving standard deviation, I obtain a P&L of 82K for RSI, 74K for Google Trends, and 75K for the moving standard deviation. So by the look of it, RSI, this weighting scheme for RSI gives me the highest P&L. And it's about the same if I look at Google Trends and the moving standard deviation. If I shift a bit up and down the ladder, still RSI is winning. It gives me the highest return, followed by pretty much both of them are in line. So here on this little table, then I aggregated, I took the average of these values across the entire sensitivity. And so then I can understand that on average RSI is going to win, but also I looked at what's the standard deviation of these numbers, meaning what's the risk that I'm making here a mistake in my judgment of the ladder. So the least risk was here, but not significantly less. And in this bar plot here, I've put all the three indicators together. I've put RSI in blue, Google Trends in orange, and gray is the moving standard deviation, where you can see that the RSI has the biggest P&L. So one thing I wanted also to say is that previously we saw that in the previous exercises, we saw that BMX could take you up to 85K. And here now with these adjustments for the cash position, this brings us to something lower, 82, 74, 75. That's something I try to think, why is that? Because here I'm supposed to be optimizing my cash in and out so that I can buy in at a better price. So my interpretation of this is that because December and January were exceptional months and there was a lot of upside volatility, it was better to be out of cash and put all your money on Bitcoin for those months where I have the data. And that's why my P&L without the cash was higher. But please feel free to question that if you think otherwise. So according to this, this is my analysis so far. Well, what I'm planning to do next is when I get what I'm planning to do next is to be able to robustify all that by looking at more data in the past, but also add some more data points in the future, because all of this right now is relying on 29 data points, which is not statistically very, very strong. All right, so I hope you found this video useful, and thank you very much for your comments last time. It was I really appreciated your good feedback, and till next time. Bye bye.